Hi, good day my viewers. My name is Kingsley Uten. I'll be taking you through a presentation I made on Power BI, showing us how Power BI could be a very powerful tool in generating insight for decision making. In this video, we would now look at how Power BI can be used to analyze cash flow of an entity and what actionable insights we can derive. Recall in the last video we had mentioned that from the analysis carried out, it was obvious that cash flow was one of the problems that the management of this entity would need to pay attention to. Now, where exactly in the cash flow of the entity is the problem lying? Well, through the course of today's video, we will look at cash flow from operating, investments, and financing activities, comparing them with some other elements of the financial statement to get a clear picture of what could be wrong. Now, starting off, we will look at cash generated to earnings before interest and tax. In this case, cash generated refers to the cash flow from operating activity before the deduction of interest and tax, and we'll be comparing it with the earnings before interest and tax generated. The ideal situation is that cash generated should either be equal to or greater than earnings before interest and tax. But if earnings before interest and tax is greater than cash generated, it simply means there is something wrong somewhere and it should be checked. And this, when it builds up, is what causes the cash flow issues most of the time. Now, why do we need to pay attention to the gap between these two things? Now, recall that sometimes in the financial statements, based on the accrual method of accounting, some activities or for which cash did not either go in or out is being recorded. So this will cause a discrepancy between the actual cash with the business and what is recorded in its financial statement. Now take for example credit sales. Now the business will record a total sale of 2 million, but the actual cash is 1.2, meaning 8 million has not yet been received. That would cause a gap between the actual cash and what is recorded. What does the data show? It shows that clearly in the first year, the amount recorded as profit was higher than the actual cash in the business. And we see this trend continues up to this point. So right from the start of the business down to the third or last quarter of 2021, the cash that is actually with the business has not always been the same with what was recorded. What was recorded has always been more than what is received, clearly showing there's still some of its cash that has not been recorded. Now, remember in the first quarter of 2022 from the last video, we concluded that the business experienced a loss and as a result caused a dip or a negative return. Yes, we see the same thing here, but the cash flow, the business did not actually spend the whole cash it had generated in that period, though it experienced a loss. But in terms of cash flow, there were still some cash left from activities in that period. So the losses recorded were largely losses resulting from accrued expenses. And then we see the status quo continued when it recovered from that loss. This time too, it experienced a loss of minus 244, but had a cash flow of 792. So now, if you look carefully in the box that appears at the tooltip, you see a breakdown of the various transactions that may have resulted in the difference. And like we mentioned, things to watch out for that could be causing problems, in the cash flow of the entity. Inventories, payables, as well as receivables. And that is what we see causes most of the discrepancies we see. Receivables, inventory, accrued, and tax liabilities, we see the same thing, over the period, clearly showing that the management of the business should pay attention to most especially its inventories and payables, and then try as much as it can to clear up the payments that is due the government that it had already recorded but had not gone out. Next, we move on to cash generated to income tax. Now, the idea behind this is to see how well the business has generated cash that would help it meet its other expenses before arriving at the net operating cash flow. And from the image, the orange color line is representing tax, and clearly the cash flow is way higher than what is due to go out. So the business is safe, so to speak, in this regards. This is the necessary expenses, so the business can still cover it with the existing cash it has been able to generate. Now we look at the net operating cash flow, comparing it with the cash operating cycle. Remember, the net operating cash flow is the total amount of cash that the business had been able to generate during the period, while the cash operating cycle is the number of days it took the business to convert its inventory down to finished goods and down to cash. What is the principle behind the relationship between these two figures? Take note that as the number of days of the cash operating cycle increases, the amount of operating cash flow would gradually decrease, meaning an increase in the number of days of the cash operating cycle would lead to a reduction in the amount of cash flow available from operations for the business. What can we now tell from our data? Now we see that during the while that the cash operating cycle was low, the business experienced a fairly stable, although there was ups and downs, but then the gap was not very wide, around 1.7 to 2.7. But then, as it gradually increased, we see a sharp decline in the amount of operating cash flow. When the number of days suddenly starts decreasing, what do we see? We see the cash flow coming up again. But then, as the number of days increased further, we see a decrease this time. So clearly showing that the cash operating cycle and the operating cash flow are negatively related. So if the management of the business wants their cash flow to improve, they should work on their cash operating cycle. And this cash operating cycle is largely affected by what we see in the list presented here. Largely our receivables, our inventory, and payable. So if the business is able to work on all of these, it would go a long way to improve its cash flow, giving them more operating cash inflow. Next, we are moving on to changes in investment activities. Now, the graph here shows the net investment for each period. That is the difference between what was invested in a particular period and what was recovered in that same period. The difference. Now, what is the trend in the data? From what we can see, we notice that the business experienced a couple of net investments. That means they invested more in some period. That is 1, 2, 3, 4, 5 different quarters, but then they recovered some of their investments in 1, 2, 3, 4, 5, 6 quarters, although their investment was way higher than their recovery, meaning they still have some investment that will be recovered in the future. But what can we tell from the individual quarter? Well, in this quarter, as we can see, they invested 3.6 million naira and recovered 624,000, meaning they invested more at about 2.9, roughly 3 million more than they were able to recover. We see for the second quarter of 2022, they had more recoveries. They invested 1.5, recovered 1.6. They recovered more. Here they invested 10.2, roughly 10.3 million, recovered 700,000, leaving them with a net investment of about 1.53. In this period, they had more of recovery. Same here, more of recovery, this times in hundreds of thousands, not in millions. But the next quarter, that is second quarter of 2022, saw them investing more again. Yes, investing probably into fixed assets, something light, small fixed assets. They invested 2.3, recovered 600k for that period, and this happens to be their highest recovery period. They invested 6.2 million and recovered an investment worth 10.67 million. Probably it could be this investment they made here is what they've recovered with return in this period. Remember, they invested 10.2 million here, and in this period they recovered the 10.2 million, but this time with an interest shooting it up to about 10.6 for that period. So taking out the new investment they made of 6 million for that period, they are left with a net investment of 4.36. Now the same thing applies to these other periods, as we can see. So the impact of these is that it would affect not their cash generated balance but their bank accounts. Yes, this would cause their bank account to shift. The more investments made, the more reduction we see in their bank balance. Now we move on to changes in financing activities. Now this one gives us the amount that had been injected and withdrawn from the business over the various quarters. And as we see, there has been a total of 6 injections and 9 different withdrawals after the initial investment. Now in the first quarter, we saw that there was a total of 1 injection, and that is let's see if we can get the exact amount. Oh, it's not coming up. It's too tiny. In the second quarter, there was no injection, no withdrawal. Third quarter of 2022, still 0. Fourth quarter of 2022, no injection, no withdrawal. But by the first quarter of 2021, we saw 2 injections and 3 withdrawals. And it happens that the withdrawal was more by 25,000 naira. So they withdrew more than they injected. Although by number, they injected twice, maybe very minimal amount, and then withdrew once, and that once they withdrew was greater than what they had left in the business. By the second quarter of 2022, we saw 1 injection, 1 withdrawal, 500 naira, very small. Maybe probably the owner of the business had bought something on credit and had not paid, so it was recorded to him as a withdrawal, probably. By the third quarter of 2022, we saw 2 withdrawals amounting to 2.8 million. Remember, now moving on to net cash increase. This net cash increase is aggregate of their operating cash flow, investment cash flow, and financing cash flow. Now, sum of everything is shown by the orange line. We notice from the first quarter of 2021, they had net cash decrease. 2021 first quarter. The second quarter, they were able to make a net increase, but very minimal, nothing compared to what was lost. Now in third quarter 2022, we saw a further decrease, largely resulting from investment activity. Remember, this large amount invested in that quarter is what resulted in this large decrease. They initially had a positive cash flow from operations, but then from investment activities, they wiped 9.5 million out, resulting in roughly 7.3 negative. That is, they spent what they generated in this period plus cash from other period. Next, we saw a positive cash flow this time of about 2 million, positive net cash flow after the 3 activities, largely from operations, then investments. Some investment they recovered added to it. We also see another increase, investments and operations contributing positively, while financing cash flow affecting it negatively by a reduction of 25,000 naira. We saw another positive one, but then it would have been more because operations gave 2 million, but investment activity and cash flow from financing activity brought it down. We saw a positive one from the third quarter of 2021. We saw another positive one from the fourth quarter of 2021, but into the first quarter of 2022. Remember, this was a period where it experienced its deepest fall. Although it had a positive cash flow, but still in this period that activities are declining, the company had spent a whole lot on investment, and even the owners of the business have taken out cash, not considering the fact that it wasn't even generating enough cash to meet all of this, clearly showing that the business has to be very, very conscious with its cash position. The same can be said from the second quarter of 2022. So clearly, the business is spending so much into investing. We understand the business is just starting up and all of that, but then withdrawing so much from its finance by the owners of the business really makes no sense. This can negatively affect the business, and now we've seen one key reason into why the cash flow of the business may not be going as fine. The owners of the business have taken out money, leaving the business with very little to run its operations in the most effective way, coupled with the fact that the company has to invest. So clearly the cash flow of the business needs to be thoroughly paid attention to so as to see better ways of improving. It is recommended that the managers of the business look for a way to bridge the gap between the cash generated and earning before interest and tax by carefully monitoring the way they give out credits or they sell on credit, and also carefully monitor the way that they manage their inventory. It's also recommended that the owners of the business do not continue in the habit of withdrawing funds for the business, as this could be detrimental to the long-term progress or success of the business. So, insightful not so, indeed Power BI is a powerful tool that we can use to make informed decision on the health and well-being of our business. So this is how we come to the end. Next, let's see working capital management. Remember, we've mentioned that inventory, account payables, and account receivables are very significant. Now, in the next video, watch out and see how we can dig deep into the working capital management of the business and see what can be improved. Would you like to get actionable insights from your data to grow your business? Power BI can help you do that. And I still remain your Power BI guy, Mr. K. Reach out to me via email, by call. To learn more on how Power BI can contribute to helping you grow your business, you could visit my website or see my LinkedIn profile for more ways that Power BI can help grow your business.